Welcome to this explainer. Today, we're diving into how wealth and risk are managed at the absolute highest levels. But hey, instead of jumping straight into a bunch of complex financial math, we're going to start with a very real-life problem, one you might actually face every single day. Picture this. You're a manager, and you've got to allocate a budget across different business projects. You've only got a finite amount of money, right? So do you put everything into one safe, boring initiative that pretty much guarantees a modest return? Or do you risk it all on a highly volatile moonshot that could totally make your year, but could also completely flop? It's a classic resource allocation problem. And honestly, finding that perfect balance is incredibly difficult. You might be looking at Project A, your safe, steady bet, and comparing it to Project B, which is super volatile but has massive potential. Now, in the real world, these projects are what economists call lumpy. They're discrete. You can't just fund, say, exactly 44% of a project. It's usually all or nothing. Plus, they carry sunk costs. Once you pull the trigger, they're really hard to abandon without losing everything you've already put in. But here's the thing. The core logic of how you should evaluate them stays exactly the same. You cannot look at these projects in a vacuum. You literally have to view them as an interconnected team, figuring out how each individual project contributes to the overall risk and return of your entire operation.
Okay, so let's really dive into this. This logic, the idea of capturing your risk tolerance and evaluating a collective group of assets, whether we're talking about corporate business projects or Wall Street financial instruments, is the exact foundation of a Nobel Prize-winning framework. This whole concept of balancing risk and expected return across a whole group works everywhere, and it fundamentally reshaped how the entire world looks at money.
Section 1. The Basics of MPT.
Let's pull back the curtain and look at the theoretical basics of this framework. It was introduced by the economist Harry Markowitz in a landmark 1952 paper, a paper that actually won him the Nobel Memorial Prize in Economic Sciences. So what exactly is it? Modern portfolio theory, or MPT, is a mathematical framework for assembling a portfolio of assets so that your expected return is maximized for any given level of risk. Essentially, it formalizes that classic age-old advice: don't put all your eggs in one basket. MPT shows us that an asset's risk isn't just about how it performs all by itself. No, it's about how its variance contributes to the overall risk of your entire portfolio.
So, the absolutely crucial point here is that rational investors are inherently risk-averse. If you give an investor two portfolios with the exact same expected return, they're always going to pick the less risky one. Makes sense, right? Because of that, an investor will only take on extra risk if they are directly compensated with a higher expected return. Now, when you build a portfolio under this model, your total return is just a simple average of the returns of everything you hold. But your total risk? Well, that's a whole different story. Your total risk is determined by how those assets actually interact with one another.
And this brilliantly illustrates the concept of correlation. Let's say you have asset pairs with a correlation of 0. That just means they don't move together at all. Assembling them into a diversified portfolio dramatically reduces your total risk. The overall variance of the portfolio drops because the individual day-to-day fluctuations of those assets just start to cancel each other out. This is, quite literally, the mathematical magic of diversification.
Section 2. Finding the efficient frontier.
Okay, we know diversification works, but how do we mathematically map out the absolute best combinations of these assets? Well, imagine plotting every single possible combination of risky assets onto a graph. One axis is risk, or volatility, and the other is your expected return. You could compare endless portfolios, kind of like the hypothetical ones we're looking at right here. You've got some with low risk and low return, others with high risk and high return. If you were to plot every single conceivable combination, they'd end up forming this massive cloud-like region on your graph.
Now, the outer left and top edge of that giant cloud of combinations, that is what we call the efficient frontier. People often call it the Markowitz bullet because it has this distinct curved hyperbolic shape. This boundary represents the absolute best expected return you can possibly get for any specific risk level. Anything inside that curve is just suboptimal. You'd basically be taking on way more risk than you need to for that specific level of return. A rational investor is only ever going to want a portfolio that sits perfectly right on this efficient frontier. But here's where it gets really interesting. How does this math change when we introduce the real world? The Markowitz bullet assumes you're only holding risky assets. But what if we throw in a perfectly safe asset? Think short-term U.S. Treasury bills, which have essentially zero variance. When you blend that risk-free asset with your optimal risky portfolio, that curved efficient frontier suddenly changes into a straight line. We call this the capital allocation line. By holding a mix of the risk-free asset and the risky portfolio, you mathematically improve the risk-to-return combinations available to you, pushing your potential outcomes even higher than that original curve.
Section 3. Pricing risk with CAPM.
So how does this whole overarching framework tell us what a single individual asset should actually cost? Well, first we have to separate risk into two entirely different buckets. Bucket number one is specific risk. This is the idiosyncratic risk tied to an individual company or asset, like a CEO suddenly resigning or a factory catching fire. As we've just learned, you can completely eliminate this risk through a diversified portfolio. It just cancels out. But bucket number two is systematic risk. This is market-wide risk. Think interest rate hikes or a global recession. And the tough truth is, no matter how much you diversify, you cannot escape systematic risk.
Because specific risk can be diversified away, essentially for free, the market isn't going to reward you for taking it on. Therefore, an asset's true riskiness in this model is solely based on its systematic risk. We measure this using something called beta. Beta basically represents how sensitively an asset reacts to the movements of the overall market. Think of it like this. A beta of exactly 1 means the asset moves perfectly in sync with the market. A beta higher than 1, that means it's more volatile than average. And a beta below 1 means it's less volatile.
Which brings us directly to the Capital Asset Pricing Model, or CAPM. The logic here is surprisingly elegant. First, you start with the risk-free rate. Then you look at the expected extra return of the overall market, you scale it by the asset's beta, and you just add them together. That simple calculation gives you the exact expected return an asset should theoretically have. If an asset's real-world price doesn't align with this CAPM-derived rate, well, then the asset is either overvalued or undervalued by the market.
Section 4. Flaws in the formula.
As incredibly elegant and mathematically sound as this Nobel-winning framework is on paper, we have to be totally impartial here and look at how critics argue it breaks down when exposed to our messy, unpredictable reality. See, modern portfolio theory leans heavily on normal, Gaussian distributions, what you and I commonly know as the bell curve. The author Nassim Nicholas Taleb actually harshly critiques this. He argues that financial returns absolutely do not neatly fit into a bell curve. Instead, they're highly prone to skewed distributions and extreme outliers. By treating market prices as Gaussian, MPT effectively ignores the likelihood of catastrophic, highly improbable events, those things we often call black swans. That makes the model fundamentally detached from extreme market realities.
Similarly, Douglas Hubbard points out a massive and, frankly, kind of terrifying structural flaw. He notes that MPT, and models just like it, rely heavily on probabilistic, backward-looking data. Basically, they look at historical variance to predict the future. Hubbard makes a great point. If nuclear engineers ran risk management this way, they would never be able to compute the odds of a meltdown until one had already happened multiple times. MPT assigns probabilities based entirely on the past, but it completely fails to model the underlying structural causes of why a sudden liquidity crisis or market crash might actually happen today.
To summarize these critical perspectives, NPT's use of variance as a measure of risk is completely symmetric, meaning it treats abnormally high returns as just as risky as abnormally low returns. That completely ignores the psychological reality of loss aversion. Let's be real, human beings care a whole lot more about losing money than they do about unexpected gains. Combine that weird symmetry with its reliance on backward-looking historical data and normal distributions, and critics argue you're left with a model that works perfectly in a pristine Excel spreadsheet, but really struggles to anticipate actual, real-world structural crises. Which leaves us with this final thought for our explainer today. Modern portfolio theory fundamentally changed how we allocate everything, from internal corporate business projects all the way to trillions of dollars of global wealth. It mathematically proved that diversification is the closest thing finance has to a free lunch. But given its rather large blind spots regarding extreme events in human psychology, we have to pause and ask, can any perfectly balanced mathematical formula ever truly capture the wild, messy unpredictability of the real world?